Welcome to the Explainer. So let's dive right in, because we've got a seriously fascinating case study today. We are taking pet insurer Trupanion, ticker symbol TRUP, and running it through the ultimate financial gauntlet. We're going to apply the legendary valuation frameworks of Warren Buffett, Peter Lynch, and Benjamin Graham, alongside a modern discounted cash flow analysis to try and find this stock's true intrinsic value. If you've ever wondered how the greatest investing minds would look at a highly debated modern company, you are definitely in the right place.
Here is our roadmap for today. We'll start with a company snapshot, look through the Buffett, Lynch, and Graham lenses, run a DCF and some alternative models, and then finish up with our synthesis and final verdict. Let's get to it.
Section 1. Company Snapshot. Before we even try to value this company, we really need to understand the core conflict here. Because right now, there is a massive divide between Main Street and Wall Street. On one hand, you've got furious consumers. Pet owners in places like California are reporting massive price hikes. We're talking like a 46.7% premium increase one year, followed by a 33.7% increase the next. That's pushing monthly costs from $128 to over $250 for older pets. But on the other side, financial analysts on Substack are actually celebrating Trupanion's healing margins, specifically pointing to a record 14.2% subscription-adjusted operating margin. So Wall Street loves the profitability, but consumers are really feeling the pain.
All right, let's look at the hard numbers. At a current price of $25.47, giving it a $1.13 billion market cap, Trupanion is pulling in a very solid $1.48 billion in revenue with 12.3% year-over-year growth. Honestly, that looks great. But then you look at profitability. A price-to-earnings ratio of 46.4 times is quite high. Almost as high as a vet bill for a swallowed sock, right? Especially when you consider the net profit margin is a razor-thin 1.7%. And the most glaring number of all, a debt-to-equity ratio of 27.7x. I want you to keep that massive debt load in mind as we move forward.
Section 2. The Buffett Lens.
So how exactly would the Oracle of Omaha view Trupanion? Let's run it through Buffett's core checklist. First up, does it have an economic moat? Actually, yes. Trupanion has a patented direct-to-vet payment system that pays veterinarians directly, in seconds, right at checkout. That is a truly unique competitive advantage. But wow, that is where the good news completely ends. Buffett demands consistent earnings, but Trupanion just barely turned a tiny $4.9 million profit in Q1 after a history of losses. That's a fail. He also wants high return on equity, so his capital compounds efficiently. Trupanion's is only 7.1%, another fail. And most importantly, he demands manageable debt. As we just saw, their debt to equity is 27.7x. That's an enormous failure in Buffett's book.
Because of that immense debt load and the lack of consistent historical owner earnings, if we ask what price Warren Buffett would buy this stock at today, the answer is mathematically zero. Literally zero. There is absolutely no margin of safety here for an investor seeking high returns on equity and low debt. It just violates way too many of his core rules.
Section 3. The Lynch Lens.
All right, so Buffett is completely out. But let's see if growth-focused Peter Lynch sees something Buffett didn't. Lynch likes to categorize stocks into specific buckets. Based on our source data showing 12.3% overall revenue growth and an even stronger 16% growth in subscription revenue, Trupanion actually fits perfectly into Lynch's fast grower category. And he typically loves companies expanding at double-digit rates.
But here's where we hit a bit of a snack. Lynch relies heavily on the PEG ratio, that's price to earnings divided by growth. Our data sources list Trupanion's PEG ratio at negative 0.1x. So we really have to show our work and make an assumption here. A negative PEG usually means the company has had negative historical earnings, making the standard calculation break down entirely, even though their recent EPS growth is cited as a positive 12.3%. For Lynch, this kind of erratic earnings history requires extreme caution.
So what's the final Lynch verdict? Well, it's a sell, or, at best, a very hesitant hold. While Lynch loves a fast grower, he is famously allergic to bad balance sheets. A strong balance sheet is absolutely essential for a fast grower to survive tough times, and Trupanion's 27.7x debt-to-equity ratio is just an automatic red flag for your portfolio. It totally overrides that impressive 12.3% top-line growth rate.
Section 4. The Graham Lens.
2 strikes down. Now it's time to subject Trupanion to the strict, math-heavy scrutiny of the father of value investing himself, Benjamin Graham. We start with his defensive investor checklist. Adequate size? Yes. At a $1.13 billion market cap, it passes.
But it fails literally everything else. Strong finances? Nope. That debt is way too high. Earnings stability? No. Dividend record? None. And a moderate PE? Graham usually wants a PE under 15, and Trupanion is sitting all the way up at 46.4x. It fails almost every conservative metric, but hey, let's calculate his exact intrinsic value anyway just to see.
To use Graham's famous formula, we need earnings per share and book value per share. Since the source data didn't hand these to us directly, we have to derive them from what we do have. Here's how we bridge the gap. Step 1. We take the $25.47 share price and divide it by the 46.4 PE ratio, which gives us an implied EPS of roughly 55 cents. Step 2. We take that 55-cent EPS and divide it by the 7.1% return on equity to derive a book value per share of $7.75. Step 3. We plug those right into Graham's formula, the square root of 22.5 times 0.55 times 7.75.
And that gives us Graham's intrinsic value just $9.79 per share. Compare that to the current market price of over $25. That is a massive discrepancy. As a value investor, you need a margin of safety to protect your downside, and right now, there is absolutely zero cushion here. The stock is heavily overvalued by this standard.
Section 5. DCF and Alternative Models. Those traditional value frameworks were pretty brutal, right? So let's step into the modern era and project future cash flows using a discounted cash flow model. For our base case DCF, we have to establish some clear assumptions. We'll use a 10-year forecast period. We're going to assume they can maintain that current 12.3% revenue growth rate. And to fill in the missing discount rate from the sources, we'll use an industry-standard 10% weighted average cost of capital, or WACC, alongside a standard 2% terminal growth rate for the perpetual growth method. Let's see what the math actually outputs. Looking at our sensitivity table, you can see how drastically the fair value changes just by tweaking our assumptions slightly. If you look at the middle row, with our standard 10% WACC, our base case fair value sits at $18.50 per share. Now, if we're highly optimistic, using an 8% discount rate and 14% growth, it could be worth $32.10. But if growth slows to 10% and we demand a higher 12% return, the value plummets to $11.10. Either way, our base case of $18.50 is still well below the current $25.47 trading price.
But our sources show alternative models exist too. Wall Street analysts love using comparable company analysis, looking at future EV to EBITDA or forward PE multiples rather than current book value. And their outlook? It's vastly different. The analyst's consensus median price target is a highly optimistic $39.50.
This right here highlights a massive philosophical divide. You've got the grounded cash flow reality of our DCF base case, valuing the stock at $18.50. On the flip side, you have Wall Street analysts pricing in flawless future execution and major margin expansion, setting a target of $39.50.
Section 6. Synthesis and Final Verdict.
So who's actually right here? It's time to bring all of these analytical lenses together into our master scorecard. The variance here is just extreme. Buffett passes entirely at $0 due to the debt. Graham says sell, valuing it at just $9.79 based on strict book value and current earnings. Lynch is highly skeptical of the balance sheet. Our DCF model says it's slightly overvalued today, suggesting a fair value of $18.50. Yet Wall Street says it's a strong buy with a $39.50 target.
Blending all of these insights impartially, here is our final verdict. The strengths are definitely real. A 98.35% retention rate and a record 14.2% operating margin show the subscription economics are genuinely healing. But the risks are massive. A 27.7x debt ratio, a very high 46.4x PE, and intense consumer anger over price hikes. Because the debt and valuation metrics make it just too risky for traditional value frameworks, our overall recommendation at the current price of $25.47 is a hold or a sell. Honestly, you'd want to see this price drop closer to that $18 DCF level to find any real margin of safety. I want to leave you with one final provocative thought today. We noted earlier that Trupanion's direct-to-vet payment system acts as an economic moat. But when we look at that Reddit consumer outrage over 40+% annual price hikes that are directly driving their record margins, we have to ask, if a company achieves record profitability by pricing out its oldest, most loyal customers, is that economic moat actually just a mirage? It's something every investor needs to carefully consider. Thanks for joining me on this explainer, and as always, keep questioning the numbers.